In this lecture, we'll talk about the price earning ratio. This is another model or method to find the value of a stock. In other words, to find the price of a stock. In this lecture, we have few learning objectives. For example, we will see that what is PE ratio and how to interpret the PE ratio. We also see that what is the relationship of the value of the PE ratio with the growth or value stock. Third, we will look that there could be the risky interpretation of the PE ratio. So we have to be very careful about the interpretation of PE ratio. Otherwise, if we do not know in detail about the PE ratio, we end up interpreting something wrong. And finally, we will apply the PE ratio model to find the price of the stock, especially using the value line investment survey reports. So the value line investment survey reports are generated by Value Line, and these are helpful for the investors to find the price of the stock. First of all, the PE ratio, this in fact it's actually also called the ratio analysis, price ratio analysis. It is used a lot by the financial analyst to find the price of the stock, even more than the discounted dividend discount model. So PE ratio stands for the price to earnings per share ratio. So over here, the P in the numerator means price per share, and in the denominator, earning per share. In simple words, it suggests that how much investor is willing to pay for each dollar earned by the company's share. And if it is high, it means investors has high hope regarding the growth of the company. And what do we mean by the growth of the company? It means that growth of the earnings of the company, right? So for example, now if the stock price is $250 and the earning per share is $5, then PE ratio suggests 50, right? So the investors are willing to pay $50 for each dollar earned by the company's share. This will lead us to a discussion to the growth stock and the value stock. So if we have a situation where we have two stocks and both have the same earnings, but one share has high price compared to the other, what could be the reason? The obvious reason is this, that the stock for which we have a high price, that stock might be investors are thinking that this company's stock have high growth potential going into the future, so their earnings can be very high. That's why they are willing to pay much more price compared to the other stock whose price is less. So it means for the same earnings, one stock have high PE ratio and the other stock has low PE ratio. So the high PE ratio stocks are called the growth stocks, and the low PE ratio are called the value stocks. So the reason they are called value stocks because they are considered cheap relative to the current earning. So there is a value for this investment. So like you are getting much more value for investing in that stock. So with the low PE ratio, the stock is called a value stock. If there is a high PE ratio, then it is called a growth stock. Now, important thing to remember over here is this, that only time will tell which stock turns out to be a growth stock in reality and what will be the value stock. So this is at this time when you are calculating the PE ratio, these are just the labels, growth stock and value stock. The second point which is important to remember is this, that PE ratio can not be stable. For example, if there is a company who has a big write-off in 1 year, so they might have done a lot of expense, so their earnings has decreased. And if their earnings has decreased, investors know that this is just a one-time write-off. So the price will not decrease a lot, but that will result into a high PE ratio because the earnings in that year is suddenly got decreased, but the price remains the same. So it does not convert a value stock into a growth stock. The same situation is other way around. If somehow in a particular year there is a high earning, for example, in the pandemic right now, having something having happening with the, say, a sanitizer company, the company which is generating sanitizer, and only this year they might have a lot of earnings, right? So investors might be thinking only this year it's a lot of earnings, so their price might not change a lot, and this result into a low PE ratio. So it means that it might be still a growth company, but this situation will not turn it into a value stock because this is only a one-time situation. Because it is difficult to compare companies that have different PE ratios. So investor managers often calculate PAG ratio. So the PAG ratio is actually the ratio of PE ratio to the expected earning growth. And it suggests that all else equal, lower is better, lower PAG ratio is better because it means that we are paying a small amount relative to the earnings. Now, let's see the application of PE ratio. So, this is the formula. If we want to find the expected price, we need to have a historical PE ratio. So, in other words, we can take the average of the last PE ratios and it multiply it with the projected earnings per share. So we will assume that the main idea over here is this, that this historical PE ratio will not change. And if we have a projection about the earnings per share, we can multiply it with the historical average to find the expected price. So the expected price will increase in such a way that when it will be divided by the projected earnings per share, the historical PE ratio will not change. That average will remain the same. So projected P earnings per share, this one over here, can also be written as current earnings per share multiplied by 1 plus projected earning per share growth rate, right? So the expected price is this, his means historical PE ratio multiplied by the current earnings per share multiplied by 1 plus projected earning per share growth rate. So if there is an ABC company and its 5-year average P ratio is $14.6 and the current value of earnings per share is 2.23, then the growth rate is 8.3%. If this is the data, we can easily find the expected price by multiplying the historical 5-year average PE ratio 14.6 with $2.23, which is the current earnings per share, and multiplying it with the 1 plus the growth rate. The growth is 8.3. So 1 plus 8.3% is 1.083. And the expected price will turn out to be $35.26. In reality, many analysts use the value line investment reports to find the expected price of a stock. So this is a snapshot of a very recent value line investment report regarding the Walmart. So the data which we need from here is annual price earning ratio, PE ratio, earnings per share, this one over here, this line. I have highlighted it over here, and PE ratio, and the growth rate. So on the same report, this is only a one-page report. So the second half of this page is this one. So we have the annual growth. So the annual growth is 7.5% for the earning. So we can use this data and simply plug in the formula which I have just mentioned previously. So if we see this data I have tabulated in an Excel file. The PE ratio for 2019, 2018, 2017, 16, and 15 for the Walmart is over here. So I simply took its average. It turned out to be 18.26. And the recent earning per share is 4.93. So we are using these numbers over here. Plus the growth rate was 7.5%. You can go and within this video on the previous slide, and you can see that for the earnings, the growth rate was 7.5%. So if I will multiply this 4.93, which is the recent earning per share, with the 1 plus 7.5%, and then multiply it with the historical average of price earning ratio, which is 18.26, I'll get that the expected share price is $96.77 for the Walmart. This will be the price by 31st December 2020. And if you see, today is actually the 5th July. Walmart is already trading at a higher price. So there is a difference. So according to the PE ratio, the Walmart share is getting traded above this price, so it is overvalued as per this method. So in this video, what we have seen that what does it mean by PE ratio and how we can interpret it. We also have seen that what is the relationship of the P ratio with the value and growth stocks. And finally, we used P ratio to find the expected value of a real stock, which was Walmart in this case, using the value line investment report. So we basically gathered all the data from the value line investment report and found the expected price of the Walmart. Thank you.